China's Belt and Road Initiative was often criticized by the media for being a debt trap diplomacy. The most notable example was the story of how Sri Lanka lost its Magampura Mahinda Rajapaksa port to China. China funded the port development by paying 85% of the USD 361 million project costs. Also in the contract, 2 Chinese firms were hired under this project. On Sri Lanka's side, the nation was able to hasten its development. While this appears like a sweet deal, there's a catch. Sri Lanka must service its debt to China by paying an annual interest rate of 6.3%. With the high interest rate, Sri Lanka was unable to service its debt, which ultimately caused them to lease the port to China for 99 years, starting from 2017. As BRI is a global development strategy, numerous countries were offered development finance by China. Under the premiership of Najib Razak, Malaysia signed several investment deals with China, notably the East Coast Rail Link project, which was reported to cost Rm 65.5 billion. However, it hasn't been an easy route for the ECRL, especially after Pakatan Harapan's takeover. The government swung back and forth on the status of the project. In April 2019, Tun Daim Zainuddin went to China and renegotiated the ECRL deal. The project cost was brought down by Rm 21.5 billion. Currently, the cost for ECRL is at Rm 44 billion, but its length was cut by 40 km and 2 stations were removed. It was a gutsy move by Malaysia to renegotiate the deal, and the outcome was successful. One of the main reasons that Malaysia was daring when confronting with China is because of its geopolitical advantage. Malaysia owns the Straits of Malacca. It is a crucial sea route for traders to navigate around Asia. Being a part of the sea lines of communication, the narrow Straits of Malacca facilitates nearly 85% of the Chinese oil import route. In addition to being an oil import route, the SLOC is the lifeline to the seaborne commerce, the most cost-effective type of shipping for trade. China may have secured Colombo under its belt, thus successfully safeguarding one of the maritime choke points along the SLOC. But if Malaysia were to block any shipping from China through its Straits of Malacca route, China will be on the losing end, as such blockade could leave a huge impact on China's trade export activities and hurt its domestic economy. Alternatively, China could weave their way from the Straits of Malacca through the Indonesian islands. By going through open seas like the Java Sea, the Andaman, and to the Indian Ocean, the shipments are prone to get attacked by pirates and terrorists, as those territories are less secured and not heavily patrolled like the Straits of Malacca. Geography and feasibility-wise, the alternative routes pose a much higher risk, since there are active volcanoes surrounding the Sunda Strait like the Anak Krakatau, making the western parts of Sumatra prone to earthquake and tsunami. Moreover, the alternative routes are much longer than the Malacca Straits, and there is much lesser infrastructure on the outer side of the Sumatra island to handle cargo ships or tankers. In summary, it is not economically viable for China to explore for a new route, leaving China back to Malaysia as its best option. Thus, it is best for China to agree with Malaysia's demands, just as long as it is not too ridiculous.